Gold prices are beginning to do something extremely strange around the world that they rarely, if ever, have done. And that is they are being priced differently around the world with a premium in China. And in the second half of this video, we are going to go over an incredible opportunity from today's sponsor, West Red Lake Gold Mines. So make sure you stick around for that. The price of gold over the last year to 2 years has been extremely resilient. This is in contrast to what many traditional economists would have expected, given what has happened to the dollar and real yields over that same time. This has caused many analysts to flip and are now bullish on gold, with some expecting it to hit up to $2,500 per ounce. TD Securities expects gold to move above $2,100 to an all-time high later this year or in early 2024. Some are calling from an increase in its price of over 25% from where it's at to $2,500 by the end of 2024. That call by David Neuhauser from Livermore Partners is echoed by the CEO of Wheaton Precious Metals. Now, there are a number of factors for this bullish outlook on gold. The first one is that we are in an extremely restrictive interest rate environment. Despite that, the price of gold has maintained resiliency, still hovering near all-time highs above $1,900 per ounce. Here's another view zoomed out to the 1970s, showing that its current trading level from a technical perspective looks very bullish and on the verge of a breakout. This strength in gold has happened despite the fact that even over the last couple of months, the dollar itself has been rising since late July. Real yields have been rising over the exact same time frame as well. As gold is a non-performing asset, meaning that traditionally when you just hold gold, it's not producing a yield for you, this would indicate that you should be bearish on gold in a rising real interest rate environment, because you would attract more capital to the assets that produce a higher real yield rather than a safe haven asset like gold. But that's not the way it's playing out, meaning that big money is keeping gold for reasons that we're about to explore. Essentially, gold tends to perform well during economic uncertainty. This means if we do tip over into recession, then you get a flood of money, of capital, out of risk assets into the safe haven assets, things like gold. Many economists also expect, which this part I disagree with, but many do expect that the Federal Reserve would pivot at that point, lower rates, maybe even reignite inflation, and that would be a fuel dumped on the fire for the price of gold. But even without that, we've seen higher demand for gold coming from central banks. Of course, with the trade wars and the currency wars and everything going on with even the hot wars, we see many nations, many central banks looking to diversify and move their assets into safe haven assets that other countries can't control should allegiances change. This is driving up demand for central bank gold. And if you live in the United States, you may not be aware of this, but the third factor that is driving the price of gold higher, and in many places driving it to all-time highs, is inflation. Or said another way, the devaluing of one's own currency. In many places around the world, such as Japan, we are seeing gold at record highs, like gold priced in the yen. Now, obviously, gold being at a record high is not something that you would notice if you're just looking at it priced in dollars. But if you're looking at it priced in a currency that's been collapsing, then yeah, you're going to notice that gold has been continuing to climb to new highs, new highs, new highs for a while now. In fact, Japanese investors in gold are up around 18% year to date. And Japan is not the only place where gold prices are hitting an all-time high. We look at the Shanghai gold price, it hit another record while Beijing warned against dumping stocks. And that's where some of the strange price action is starting. It's coming out of Shanghai, where we're seeing wildly divergent prices, even when you look at them in terms of dollars. Spot prices for gold in London were around $1,900 per ounce as of September 13th. While at the same time, priced in dollars on the Shanghai Gold Exchange, we were seeing $2,029 per ounce. This premium in Shanghai for gold is not new, but it's never been to this extreme before. For the last couple of months, this premium has been around 1.9% and reached a record 6.3%. John Reed, who is a market strategist at the World Gold Council, said that he has never seen moves like this, and he's been tracking the Shanghai Gold Exchange since it started. Due to this arbitrage, the difference in prices based on locations, it's possible we are seeing physical metal move east. One of the factors causing this difference in pricing could be China's import curbs. Apparently, China is trying to limit gold imports. Now, at this point, as the time of this recording, number one, this change, this gap, this massive premium is still new. So it's still unclear why this is happening. It's unclear how long this will persist for and what the results of this will end up being. There's some speculation that China is attempting to stave off the collapse of its yuan, that they are attempting to increase demand for the renminbi so that it can be used in exchange for the petro yuan, trying to discourage the exchange back to US dollars. So it's certainly some strange things happening right now. And again, it is unclear how this is going to play out or whether it's just smoke and it won't turn out to be any fire at all. But it's very interesting and curious, and it's starting to turn heads. And given the fact that investors in gold have been so disappointed with the price action, and many investors believe that the price of gold has been suppressed due to paper trading and manipulation and the suppression of the gold price through paper gold, this premium Shanghai could very well indicate the first signs of price discovery moving to a physical market in Shanghai, and the first signs of that paper manipulated market starting to crack and starting to break. It might mean very exciting times ahead for gold investors. But gold investors are tired of waiting for some price movement that may or may not happen in the future, as they've been disappointed time and time again, which means that when investment opportunities in companies come along that don't rely on the price of gold moving higher, it makes them all the more attractive. That's where today's sponsor comes in, West Red Lake Gold Mines, symbol WRLGF. West Red Lake Gold Mines is one of those companies with an opportunity that really does not come around that often. Essentially, we need 3 legs to a table for it to be able to stand upright without falling over, and it's the same with companies to invest in. Number one, you're gonna have to look at the management team. Do we have people in place with a track record of doing great things with similar companies before? And if so, you've got 1 leg to the table. The second leg that we're looking for is going to be the asset, the mine, the resource, and basically how close is it to becoming what you want to look for. And in the case of a gold mining company, that's the question of how close is it to actually spitting out real gold out of the ground. And then the third leg of the table that we're looking for is price. You want an attractive price to be able to buy this thing at, so you can get in at a great price before the market realizes the value that's there. And all 3 of those elements are present with this company. So first, let's take a look at the management team, starting with the CEO, Shane Williams. The last position Shane Williams held was the chief operating officer of a company that he took from $1 per share all the way to $16 per share in the span of just 3 years, from 2019 to 2022. And this wasn't a one-off. He's done 4 different gold mines, massively successful in the last 20 years. Director Tony McCouch was the CEO of Kirkland Gold. Tom Meredith, the executive chairman and director, was a CEO of Agnico. Duncan Middlemas, a director at his last company, led a 15 times increase in share price and brought a mine into full production. And just in case that leadership team wasn't enough, we can take a look at who has invested in this company. And we can see, number 1, we've got Frank Justra at 11.8%. You know, this guy, self-made billionaire who I'm sure you've seen all over interviews on YouTube, being interviewed on channels like Kitco and Real Vision for his views on economics, inflation, gold, and much more. On top of that, we have names like Sprott and Van Eck Gold Funds, and just those 3 own over 40% of this company. This ownership structure shows high conviction. So what is it about this company, this project, that gives them such high conviction in this play? Well, basically, this mine is already built. The last company that owned this property spent years building this entire mine. They did the geology, it's in the right area. This jurisdiction in Ontario is called Red Lake, and there are over 25 mines in this area that have been brought into production. So the last company that owned this property, they built this whole mine out. So it's all there. It's built. It's ready to go. There's no operational issues. They've got a team in place. This is not one of those properties where all you have is maybe 1 drill and they're just looking to improve their drilling results and to show that, hey, there's actually some decent gold here, hoping that they can sell the property to somebody else. This is a property that is pretty much ready to be brought into production. So the question is, how did they get this property then? Because the last company who owned this property built this. What did they do wrong? Well, essentially they fumbled on the 5-yard line with money. They built this whole thing and they spent over $350 million developing it. While the last company owned it, at its peak market cap, this property alone was worth $1 billion. It's like, they know there's gold there, and they built the mine to get the gold out, and they were almost ready to put it into production. But because they over-leveraged themselves, had too much debt, and then COVID hit, they fumbled the ball on the 5-yard line and then had to sell this property at rock bottom price. Meaning that West Red Lake Gold Mines, who owns this property, is now only valued at $54 million. In today's dollars, if you wanted to build this exact same thing right next door, it would cost somewhere in the neighborhood of $700 million to do so. Problem is very clearly not the asset which is ready to go into production. It was simply the former management team. And so the market is currently pricing West Red Lake Gold Mines as if there's something wrong with the property, because the last company that owned it had to sell it for fire sale prices. So the first step in the plan, what they're going to do here is define a critical mass of high-grade resources. Once they've done that, they're going to optimize the project to focus on cash flowing. And then after that, they'll restart execution and focus on profitability. Each one of these steps along the way will show the market that it is much more valuable than what it's currently being valued at. Remember, at its peak, this property was valued at over $1 billion. Today, it's being valued at $54 million. And the plan here is to actually bring this into production, not just sell it off to somebody else. Hope that somebody else is willing to pay a higher price. They're going to focus on profitably bringing this into production and starting to cash flow. Today, they are sitting on $15 million in cash and 0 debt. If you take similar sized companies that have similar sized assets and are actively producing, those companies are currently being valued at around $5 to $10 per ounce. This project has the capability to produce 100,000 ounces per year, which would put this company at a valuation somewhere in the neighborhood of $500 million market cap up to $1 billion market cap, which from its current market cap is in between a 10 to a 20x upside. So this company has the management team, they have the investors with high conviction, they have the asset in place, they're ready to go into production, the company has the fundamentals that are there, they're not looking to sell it to the next person, and based on current valuation compared to what it could be in the future, represents an opportunity to get in on something that could 5, 10, or even 20x over the next couple of years. As always, with any investment, you're going to need to do your own research. This is not investment advice, nor is it a trade recommendation. Always exercise proper risk management so that if the trade or the investment moves against you, you know at what point you're going to get out. And I want to give one final thanks to West Red Lake Gold Mines for partnering with me and sponsoring this video. And thank you so much for watching. Have a great day.